Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is our good friend, Joe Brown from the Heresy Financial YouTube channel. Joe, welcome back.
Hey, thank you so much for having me again.
So, Joe, you've done some great videos on a topic called reverse repos and how that's affecting, Fed policy and everything. And I wanted to dive deeper into this because something really interesting happened last week where the reverse repo market went totally spiking higher. We've been over 2
Mhm.
trillion. The reverse repos. This is where the commercial banks park their money at the Fed, and it's really just keeping on spiking higher. And we wanted to talk about the reasons why. So walk us through, in 10 seconds or less, what is a reverse repo and why does it keep going higher?
Yeah, absolutely. So this whole thing, it's like a big pawn shop. At banks, at the end of the day, they go to each other and they say, hey, I need cash or I need collateral, and then they swap with each other. Well, over the last couple of years, they haven't been able to do that just with each other effectively without having major dislocations. And so the Fed has come in to be that counterparty on the other side of that. The reverse repo is the one that all the banks have needed to use for the last 2 years or so. And that's banks saying, hey, I need collateral. Why is that? Because the Fed printed trillions of dollars. The government spent that into the economy. So all that cash flooded in. Banks need collateral on the other side of that cash deposit. And so they have to go somewhere to get that collateral. Since April of 2021, they've gotten that from the Fed themselves. And so all that cash floods into the reverse repo facility at the Fed. And the Fed pays a nice little interest rate as a bonus, as a benefit for those banks keeping that cash with them, instead of those banks going to get that collateral from the open market.
So, this is important because it dramatically impacts interest rates. Like right now, it's $2.5 trillion that the commercial banks have at the Fed. Instead of what would they be doing with this 2.5 trillion if it wasn't parked risk free at the Fed? They'd be loaning it out into the economy, things like that, right?
Yeah, essentially the main place that they'd be going with this is buying bills, very short-term government debt. And so that's what they're getting in exchange from the Fed by keeping it in this reverse repo facility, because repo means repurchase. So they give Fed cash, they get that collateral, those bills or bonds in return. And then at some point that trade unwinds and goes back and maybe they do it again. So if this wasn't happening, that $2.5 trillion would be going out to the open market and buying bonds, bills from the open market. And so this is a staggering sum of money. This is, trillions of
Yeah.
dollars in cash. And so this is like, $2.5 trillion. That's almost, that's the size of a normal deficit for an entire year for the federal government. This is absolutely monstrous, the size of cash here. So if all this money suddenly had to go get collateral from there's just not enough of it. So it would drive rates negative. They'd have to buy up along the
Yeah.
longer end of the curve. And then, so there's that would have a huge stimulus effect on the economy. And the Fed's trying to tighten right now. They don't want
Mhm.
$2.5
Yeah.
trillion of stimulus and free government borrowing for extra spending.
So what happens here is instead of the Fed's trying to drive interest rates higher to tighten issues. So if that 2.5 trillion was out there buying bonds, it would of course drive interest rates lower, which is not what they want. So how do they lure all these banks? Back here during, when interest rates were the Fed's rate was at 0% or a quarter percent, I remember the reverse repos, they would only offer these banks like 0.05% on their money. What are they offering now in order to lure all this money into the Fed? What are they having to offer and pay them right now?
Yeah, since June of 2021, the Federal Reserve has offered 5 bips over the bottom band of the federal funds target range. And so when the federal funds rate was in between 0.25%, they were paying 0.05% on the reverse repo facility, just a tad bit over. And
Mm.
every single time the Fed has raised rates, they raise that federal funds target range, they raise the reverse repo so that it's, again, still 5 bips, which is a basis point, which is 1% of 1%, over that bottom end of the Fed funds range. And so right now they're paying like 4.3% on the reverse repo facility, any dollar that's in there. And so it's just a massive amount of money. Number one, 5 bips was huge when there was just $1 trillion in there, and now it's $2.5 trillion, and it's 4.25%.
Yeah,
and
okay.
not only that, but it's risk-free. I mean, you can't get risk-free. Like, you can go to the government, loan money to government, and it's considered risk-free, but there's still a risk of default. There's still market risk if you have to sell it. This is literally the only place you can get risk-free money is by the person who has the monopoly on printing money, which is the Fed.
Okay, so right now the Fed is paying on 2.5 trillion, roughly approximately $2.5 trillion in deposits from commercial banks at the Fed. The Fed is paying roughly 4.3% risk-free interest rate returns to those banks. And so let's walk to another chart that's been very popular online.
Mm-hmm.
And this is what's called the weekly Fed remittances. And this is tracking what the Fed does with its profits from its bond portfolio. And so this is the other side of the coin from the Fed of what's happening out there. And it's worth taking a look at. So this goes back to 2010, roughly the great financial crisis. And what happened back then? Well, the Fed didn't used to have a huge balance sheet. And all of a sudden they had a $4 trillion balance sheet after the great, 2008, 2009, 2010 to reinflate the market. Now, what a lot of people don't know is the Fed, what do they do with all those profits that they're making, the interest payments they're receiving on their mortgage bonds and treasury bonds, Joe? What normally happens to those profits?
Yeah, they pay those profits to the Treasury. So the Federal Reserve, they've got their balance sheet. You can think of it like your brokerage account that has a bunch of assets in it and pays them money every single time interest gets paid. So they own bonds from the government. They own mortgage-backed securities. They're earning money on that. In a normal environment, they're making more money off the interest, the income from that balance sheet than they have to pay out for any of their expenses, including, the salaries of everybody at the Fed. Everything that's left over, they actually just give back to the Treasury. All those profits are swept back to the Treasury. And so that money is going back to, you could say, the taxpayer, making the federal government's budget a little bit easier.
Yeah. Now, so in the past decade, that's amounted to roughly, tens of billions of dollars per year in profits, interest income that the U.S. taxpayer receives from the Fed. Let's call it the Fed dividend going to the U.S. taxpayers. But something's changed dramatically in the past year, where all of a sudden the remittances have gone negative, dramatically so. And it coincides with the increase. This is a shorter term chart from 2021 with the rise of the reverse repo. So as reverse repos get higher and the Fed's paying out money at 4.3% currently on 2.5 trillion, on the other side of that shows up in where their profits are going. Instead of all those profits here for the past 10 years going to U.S. taxpayers, now all of the interest income on, what is it, 8.6 trillion? What's the bond portfolio right now? It's something like 8.6 trillion.
Around there, yeah.
All the profits now are going to not to the U.S. taxpayers. All the profits now are going to commercial banks to fund the reverse repos, right? So this is going to impact the U.S. budget deficit, right? Instead of those tens of trillions financing our own government, they're now going to, it's basically a raid on the bank, right?
I mean, and then some. The Fed is operating at an extreme loss right now. So they've got that $8.5 trillion worth of assets spitting off interest for them. And that's not even close to what they need to cover their expenses right now, because they're paying so much. One of those things is the reverse repo facility to keep that money out of the bond market. And so they're paying so much, they're just hemorrhaging money. Now, It's important to be clear because most people think this means that the government, taxpayers, the Treasury is directly funding this, and that's not happening. The Fed just prints the difference. They just print whatever they need to. And so Fed's operating at a huge loss, paying a ton of money to banks right now in order to keep all that cash out of circulation so that we don't have, more inflationary pressures and more stimulus effect on the economy. But it means that they're losing money hand over fist right now to the banks.
Well, also, you have to remember all those bonds that they've been purchasing the past 10 years at one, I think the average interest rate was, 1 or 2%, or some of them were
super
less
low
than
rates,
but different maturities. But I think the average was close to 1.5%. Well, now with rates at 4% and mortgage rates at 7%, all of those bonds that the Fed owns on their own balance sheet at very low interest rates, they're not worth as much right now. If they were to actually mark those to the current market value, I don't know what it is, but I've seen some numbers that the Fed's $8.6 trillion balance sheet, they're probably down $500 billion or more in terms of the current value relative to where current interest rates are. They don't have to recognize that loss because they're the Fed. But if they actually marked their balance sheet to true value, they've got a $500 billion loss sitting there. Is that roughly accurate?
Yeah, and it's important to remember that this is something that the Fed can probably absorb because the dollar is a global reserve currency, but the same thing is happening to central banks all around the world and in countries where it might actually cause the central bank to lose credibility and, potentially collapse economies in some developing or emerging nations. This isn't isolated to the US. This is happening everywhere. And central banks are really, really teetering on the edge of losing credibility in many different countries because of this.
Well, the Fed doesn't ever sell their bond portfolio. They just hold them to maturity. They just take, they don't make much interest as they could if they were having market priced bonds, but essentially they never take the loss, right? They just hold it till it matures, right?
For now, although depending on how sticky inflation is and how hot the jobs market is, we may see the Fed decide to ramp up and actually sell assets actively off its balance sheet instead of just letting them roll off.
So the big question mark is, how long can they keep doing this? Because you see huge changes in graphs like that. It tells you the Fed is really manipulating the markets right now in their desperation to keep things under control. And the big question mark for 2023 is, when is something going to break, right? Does the economy get so bad, whether, we're deeply into recessions? I think the St. Louis Fed just put out a report saying that we're in a recession. The Philadelphia Fed put out a report saying that over 1 million of the jobs that they claimed were created last year actually weren't created. So the job numbers are off by over 1 million jobs.
Wow.
Probably, but
which
now
is
that we're
basically
past
the entire number,
now that we're past the election, they can fix all those. I think it was because of pre-election they were playing with the numbers, but that's just, I don't have my tinfoil cap right here, but that's what I think was going on. Now we're in this situation in 2023 where we got to figure out, how long does this go before something breaks? And what does the Fed do when something breaks? Now, if you look at all their comments that the Fed voting members are making, their public manipulation comments that they make to try to manage the market, they're all saying, well, we're going to keep rates high for all of 2023 and into 2024, and we're not changing course. And, what do you think? Do you believe them? I don't, but do you believe them, Joe?
Yeah, well, one thing that we have to look at is what is happening to the inflation numbers and what's happening to the money supply. So looking particularly at the money that they're printing to pay to banks right now and saying, okay, well, what's the result of that? How long can they keep this up? Every time they go through a crisis, they have to increase how much intervention they have. So it is unsustainable in the long run. But to your question, how long can this go on? I think their number one priority right now is making it at least look like they are bringing inflation under control. Right. Now, the reality is that inflation, Milton Friedman says inflation is always and everywhere a monetary phenomenon. And that's true as long as you understand the assumption built into that statement, which is all else being equal. So we don't have an economy that stays exactly the same size with the same amount of goods and services and production. If we did, then inflation would be entirely just the money supply. You make more money, prices go up. Less money, prices go down. And so that's why in the years 1870 through 1910, we had a huge increase in the money supply equal to the years from like 1980 through 2019, approximately the same increase in the money supply, but there was no inflation in the 1800s. There was a lot of inflation this last time. And so the reason is because the economy was growing so much faster during that time that it outpaced the increase in the supply of money at that time. And so you have to compare the two, the size of the economy versus the size of the money. Now, if we do that today, the money supply has decreased year over year. Right now. That hasn't been true since the lifetime of M2 measuring the money supply. That's like 40 years or something. And so we have not seen this happen for a long time, where the money supply, the broad money supply, M2, has not increased. In fact, there's been a slight decrease from January last year to right now, as we're sitting right now. So the effect of that is prices stop going up, because you don't have more and more money continually able to push prices higher and higher. And so I think inflation is going to come down drastically very soon here. The Fed's going to take credit for it, even though it's not because of their, little raising rates or little selling assets off their balance sheet. It's because they just stopped printing trillions of dollars.
This goes back to something Michael Burry just tweeted recently about inflation. This was just a couple of days ago, first of the year. Inflation has peaked, but this is not the peak of this, not the last peak of this cycle. We'll likely see CPI going lower, possibly even negative in 2023. While we're in a recession, then the Fed will cut and government will stimulate, and then we're going to have another inflation spike. Now, this reminded me of what happened back in the 1970s. I went back and I looked up all this data, and I tweeted this a few days ago. Well, the most recent inflationary period we have in the United States was the 1970s. But in 1974, there was a recession, just like what we're having right now, what I think is going to happen in 2023. And it took inflation from 11% down to 5% by 76. The Fed declared victory and went back to easy money in 76. And then inflation soared in the late 70s all the way up to 13%. And so a lot of people think that was Paul Volcker and the Fed that was controlling inflation all that time, but it wasn't. I mean, it's my opinion. This is bigger than just the Fed. The Fed, it's not totally within the Fed's control to control inflation. And what changed in the late 70s and early 80s, and I summarized it here, was we had three major energy inputs that came into the economy. North Sea oil started flowing. The Alaskan pipeline started delivering oil from northern Alaska down to where it could make it into the markets. And Gulf of Mexico offshore oil scaled up. And that happened at the same time as the Fed was raising rates dramatically. But, so the Fed can affect interest inflation short term. Yeah, they can kill demand. Raise rates to the 20%. Yes, you will kill demand and you will bring inflation down. But as soon as they bring rates back to normal, if they haven't fixed the underlying problems in the economy, and the big problem in the 70s and now is energy prices, if they don't fix that underlying problem of energy supply, cheap, high quality energy, then inflation's just going to come roaring back. And that's the point that Michael Burry was trying to make here, is that we're just going to have another inflation spike as soon as they lower interest rates, which could be, middle or end of 2023, or, if you believe the Fed, they're going to say 2024, but I think they're not going to be able to stand having a recession depression in 2023 and be able to hold out that long, just my opinion. But, what eventually fixes this is energy policy and commodity policy. They're not allowing companies to explore and develop new mine supply. Copper, we have massive copper shortages, all sorts of commodities. They're just not investing enough in new supply. So this problem is going to persist long term. I mean, that's my opinion on what this is. And I know you have some thoughts along those lines too, Joe.
Yeah, absolutely. So this goes back to kind of the two sides of the coin for inflation and deflation. It's the money supply versus the amount of wealth in the system. And so I want to be clear. I don't think that we're going to hit 0% inflation and potentially deflation, and then the Fed is just going to say, hey, we won, and it's going to be great from there. I think that's going to cause them to take their foot off the brakes. And potentially, if we've spilled over into a deep economic recession, depression by then, they're going to hit back with some stimulus to try and bring things back up. And that's going to restart the whole thing again. And so I'm not scared of the deflation. I'm scared of the Fed's response to that deflation, because I think they're going to then go back the wrong way again. They're not going to let the recession cure the malinvestment that has taken place. Now, energy, I think, is a huge piece of this, 100%. Another piece of this is what the rest of the world is looking at in terms of the dollar. And so when we had the rest of the world bail out the United States after the great financial crisis, the rest of the world, central banks around the world, bought a bunch of treasuries. Well, it was because they thought it was temporary. It was because they thought that stimulus was short term. The Fed promised we will unwind it when we can. And guess what? They tried over and over and over again. And every time they reversed course and never did it. And in about 2018, the rest of the world realized this will never be unwound. It will never be undone. And central banks are now net sellers of US Treasuries. And they were never sellers on net. They were always buyers up until about 5 years ago. So they switched on that. People like banks like the Bank of Japan actively selling US Treasuries instead of being the biggest buyer, and they're the biggest holder. So what happens when the rest of the world sells US Treasuries? Well, they get dollars. What do they do with the dollars if they didn't want the Treasuries? Eventually, those dollars come back home too. And if everybody wants to get rid of dollars, the only place that will accept them is the United States. And the way we accept those dollars coming home is through purchasing our assets like our stocks, our real estate, and our merchandise off of our shelves. And so the energy piece, huge. The deglobalization piece, absolutely huge. And then the global de-dollarization piece as well will bring a massive amount of inflation home from those dollars we've exported overseas for decades.
Well, a lot of those central banks are also buying record amounts of gold now also, since they've decided they don't want to hold as much U.S. Treasuries. What's another tier one asset that they can hold that will be accepted anywhere on the planet? Well, yeah, gold. And so you're seeing record purchases of gold by central banks the past year or two. It's been going on for several years, but it's reaching. It seems to be accelerating now in the past year, in the midst of all this. So gold is becoming king, whereas the U.S. Treasury market is not as desirable as it used to be.
In a world where sanctions are used as weapons, central banks don't want to hold on to dollars. And so in 2022, central banks bought more gold than they have since 1967. What happened 4 years after 1967? There was a new monetary system that got established because we left the Bretton Woods. We closed the gold window. And so there's a big monetary system shift taking place underneath our feet right now. Central banks are the biggest money in the world. Big money makes the big moves. That's who we should follow. Look what they're doing, not what they're saying. And they're buying gold, getting ready for another monetary system.
They're buying gold, and silver is going to move even more than gold as it follows gold or leads gold. So anyways, we just did a nice little review of the whole precious metals bull market case. No matter what happens, the central banks are trapped. They've got to buy gold, and silver is probably going to go along for the ride. Joe, thank you very much for joining us and walking through this. We appreciate it.
Yeah.
Thank you for having me.